Well, there's still hope for a Santa Claus rally here in Australia and around the globe. As we head into the final trading weeks of the year, it looks like markets might have stabilised. And we found a circuit breaker last week in that read on US inflation. Now, it was only a monthly read coming in at 2.7%, though it was well below market expectations of a read of 3% on inflation for the month of November. And that much lower than expected inflation rate immediately saw investors jumping to the potential for an interest rate cut as early as January in the US. And of course, that boosted share prices on both Thursday and Friday in the US. And that turnaround in the outlook for interest rates in the US, or that confirmation perhaps of the bias towards easing, meant that markets might well be finding a firmer footing and with potential to head higher as we move into year end. And we really need that, because after a terrible month of November all around the globe, the Australian market has underperformed again. And last week, despite the fact that the S&P 500 managed to squeak out a 0.1% gain, Asia Pacific markets did not perform as well. In Australia, we saw the ASX 200 down by 0.9% for the week. And in Hong Kong, a very similar 1.1% fall. And so that pressure on the Asia Pacific region might ease with the pressure on global markets. We're certainly seeing an indication from futures markets when they closed on Saturday morning that we'll see strength at the opening across the region today. And that strength is concentrated very much in tech stocks, because that's what we saw bounce so hard on Friday night. Tesla shares were up 7.7% for the week. However, the contrast with Australian stocks was quite stark. Woodside, for example, a global gas producer, down by 8%. Alibaba, listed in Hong Kong, down by 5.7%. And that pressure noticeable in the Asia Pacific region. This week, we still have data coming out, despite the fact that we'll have Christmas and the Boxing Day holidays on Thursday and Friday. We'll see RBA minutes tomorrow. And of course, there'll be a very close examination of those minutes by analysts and traders to see exactly what the RBA is thinking. Later in the week, on Wednesday, we'll see GDP data, quarterly growth numbers for the US. Very important in light of the shutdown of the US government over September and October and the lack of data that we have from that period. There could be some catch-up effects as we see the quarter-on-quarter GDP growth numbers in the US on Wednesday, and one to look out for, particularly given we're expecting thin trading conditions. Any surprises on data releases this week could really have an impact on the market, with so many institutions already having put their cues back in the rack for 2025. Then on Friday, of course, while markets here in Australia will be closed, we'll also see China manufacturing data, and that growth in China also a very important read for the outlook for the Australian economy. So the question this morning is focused around gold miners, because not only did they perform strongly last week, they've been amongst the strongest performers in Australia this year. 8 out of the top 10 ASX 200 gainers this year are gold miners. And there's no surprise, really, given that the gold price hit record highs repeatedly over the course of the year. And once again, we're back in position with gold having touched levels, as measured by the futures contract, just over $4,400 last week, setting a new all-time high for that contract. And having pulled back slightly, it does look like it's rebased, and we could see another test of the all-time highs in the gold price and potentially a new high tide mark for gold. And that, of course, is very supportive of those miners, despite the fact that we've seen so many gains in the sector. And the reason for that is the outlook. A lot of global investment banks, including JP Morgan, Goldman Sachs, and Bank of America, have projected the gold price to touch $5,000 over the course of next year. Most of them forecasting later in the year, but nonetheless, a very positive outlook, another 25% gain or thereabouts, potentially, for gold being forecast by some analysts. And that sort of outlook, of course, is very supportive of the gold miners. Now, the gold mining stocks in Australia, of those 8 out of top 10 performers, are all up more than 120%. But now only 3 of them have strong buy ratings from analysts, because some of the gains have already been locked in. But those that still have strong buy ratings from analysts on the Moomoo community platform are Catalyst, Vault, and Westgold. And those 3 still have target prices that are between 17.5% and 39% above where they're currently trading. So despite the fact we have seen such strong support for gold, analysts are still projecting further gains for a number of the miners in that sector. So turning to our watch list today, first up, of course, Westgold Resources, one with a strong buy rating in the Moomoo community. It was up 2% last week. It's up 122% for the year to date. Last week, Westgold Resources announced that they'd sell a stake in their WA gold project to a gold minnow called Alicanto for a 20% stake in Alicanto. And they also mentioned that they'll be listing one of their non-core assets called Valiant. The result is that many analysts have a strong buy on Westgold Resources and a target with an upside of 18% from current levels. And turning to other stocks on our watch list today, Carnvial up 12.7% last week after a record result. And it does look like the cruise industry overall has recovered very significantly from the disruption it experienced during COVID. Net income for the year was up 60% for Carnvial, up to $3.1 billion. EBITDA was up to $1 billion. And they project that in 2026, income will increase again to $3.5 billion. So a very positive outlook after a very positive performance from Carnvial. The company will resume paying a dividend in 2026. Having paid down $10 billion in debt, it's now in a position to do so. And that strength in the balance sheet is reflected in that commitment to pay a dividend to shareholders. It certainly looks like there's been a turnaround. And a number of other cruise lines also saw good share price support last week on the back of Carnival's strong result. And last one on our watch list today, turning to Hong Kong, we're looking at Alibaba. It was down almost 6% in trading last week, but it's the biggest top 10 gainer in Hong Kong. So of all the top performing stocks, Alibaba has the largest market cap. We are hearing reports of US institutional selling, but revenue estimates for next quarter, the consensus is they'll get a further 21% lift in their revenues. On the Moomoo community, Alibaba has a strong buy rating and a target price with an upside of 28% from current levels. There's also an argument that in 2026, Alibaba could be a significant beneficiary of artificial intelligence implementation into its sales processes. Alibaba, strong buy rating in the Moomoo community.